Hello, it's Professor Marsh again, and this is Chapter 5, Homework Review and Principles of Accounting at Newberry College in the spring of 2022. We had 8 exercises and problems that were assigned, and we're going to go through those now in your book. So if you'll turn to exercise set A, and look at the first of the problems, or first of the exercises. The book is asking you to identify whether each of the following accounts is nominal and temporary or real and permanent. Now, what do we know about nominal and temporary accounts? Well, we know that those are accounts which are set up to record revenues and expenses. Those are period expenses, and also those are accounts which are set up to reconcile the owner's equity accounts at the end of each period to record the revenue summary and also the dividends paid accounts. So let's go through this with that in mind. So A, accounts receivable, is a real and permanent account. It is a balance sheet account, and it does not get closed out at the end of the period. B, fees earned revenue is a nominal or temporary account. It is a account which is set up to record the revenue for the period, and it gets closed out through income summary at the end of the period. Similarly, utility expense is a nominal temporary account. It's one of the expense accounts which is also closed out through income summary at the end of the period. Prepaid rent is typically an account that gets adjusted in our adjusting entries. Remember, in Chapter 4, we had a lot of adjusting entries related to prepaid rent because when we pay rent in advance, we set that up as an asset, but then as we enjoy the occupancy of the space, when we get to the end of the period, we make an adjustment. But prepaid rent is actually a real or permanent account. It is a balance sheet account that carries over through the post-closing trial balance into the next period. So even though it gets adjusted in the adjusting entries, it does not get closed out in the closing entries, and so it is a real or permanent account. Let's go on to number 3. For each of the following accounts, identify whether it would be closed out at year end, yes or no, and on which financial statement the account would be reported. The balance sheet, the income statement, or the retained earnings statement. So let's take a look at accounts payable. Well, we looked at accounts receivable in the previous one. Accounts payable is also a balance sheet account. If you think about our chart of accounts, it's one of the accounts that is an asset, and it would have a number that starts with a 1, okay, 110 or 1,100 or something like that in the chart of accounts. So it's a balance sheet account, and it does not get closed out at the end of the period. Accounts receivable is its corollary on the liability side of the balance sheet. Accounts receivable is a liability account, a current liability, and it does not get closed out. It carries over through the balance sheet into the next period. Cash is also an asset account. It's typically our first asset account, our first current asset account, and it also appears on the balance sheet and is not closed out at year end. D, dividends. Now, we have dividends is an account which is closed out at year end. If you remember, it's probably our last closing entry, and we close out dividends, and it appears on the retained earnings statement, but does not appear on either the balance sheet or the income statement. Fees earned revenue, that is that's a temporary or nominal account. It reports our revenue rather, for the period, and it will appear on the income statement. It is closed out at year end, and what happens to revenues? Well, they're compared to expenses, and then through income summary, remember, it gets closed out into retained earnings. But the fee earned revenue account itself shows up on the income statement. So don't get confused about that. Obviously, revenues minus expenses goes through income summary into retained earnings and then into the balance sheet, but the fees earned revenue account itself is presented on the income statement, and not on either the balance sheet or the retained earnings statement. So don't get confused about that. I know they all fit together, but what the question is asking is, which statement do you see that account? And the correct statement is the income statement. Fees, okay, insurance expense. Insurance expense is a nominal or temporary account. It's one of our expenses that appears on the income statement. Prepaid insurance is an asset account that appears on the balance sheet. And supplies, without anything else about it, just supplies, means the asset account for supplies, and that also appears on the balance sheet. And supplies, like prepaid insurance, are typically accounts that get adjusted in the adjusting process from Chapter 4, but this does not mean that they get closed out. After they get adjusted, they still show up on the balance sheet if there is a balance left in the account. If you use up all your supplies during the period, or if you get to the end of the lease and you haven't prepaid anything, then you're going to have zeros in that account, but they are balance sheet accounts that zero balance carries forward into the next period. It does not actually get closed out. Okay. Exercise set A, number 5. And for number 5, let's see what we have here. Make the 4 journal entries to close the books. Well, I'm not going to make them for you. I'm going to let you make them yourself. And you can see what you have here. What is the first journal entry? Remember, the first journal entry, we would look down through these accounts and the normal balances at year end, and we see that we have revenues. Okay, our first closing entry is to close out revenue to income summary, remember? And look at that, we have a nice fat revenue account of $90,000. So our first closing entry is going to be, since revenue is a credit balance normally, right? Then we're going to make a debit entry to the fees earned revenue, and then we are going to make a $90,000 credit to income summary. That's our first entry. Then it looks like we've got, oh, look at this, we've got 3 expense accounts. We've got selling expenses for $45,000. We've got administrative expenses for $16,000, and we have miscellaneous expenses for $2,300. So let's add that together. So $45,000 plus $16,000 is $61,000, and then add $2,300 for miscellaneous expenses, and you have $63,300. So that would be a debit balance in those total expenses, and so you would make those 3. You'd make a debit entry to income summary for $63,300, and then you would make credit entries, 3 of them, $45,000 to selling expenses, $16,000 to administrative expenses, and $2,300 to miscellaneous expenses, and that would be your second closing entry. Now, what is your third closing entry? Well, your third closing entry is to take the balance that you have in income summary and close it to retained earnings. And so your third closing entry would be to look at the difference between the $90,000 that you put in for revenue and the $63,300 that you put in for expenses, and that difference, which is $26,700, would be used as the debit entry to close out income summary. And so you would have that would be your debit entry, and then your credit entry would be a credit of that same amount, $26,700, to retained earnings, and that would close out income summary. Then, okay, what do we have left? Well, the only thing we have left is dividends. Obviously, this company paid some dividends during the year, and dividends is a debit account in owner's equity. And so the way that we close that out is we make a debit entry to retained earnings, because we're reducing retained earnings because we didn't retain 6,000 of them. We actually paid them out to shareholders. So we have a debit entry to retain earnings of 6,000. We have a credit entry of 6,000 to dividends to close out the dividend account, and those are our 4 journal entries. Okay, so I haven't made those journal entries, but on the board, but I have described them to you. Let's see if you can make them for yourself. Okay, now exercise 7 says make the 4 closing entries from the T accounts. Now this should be even easier. So you can see the balances that we have. This is basically the same question, but instead of giving you just a list of accounts, it's basically the same problem as number 5. So I'm going to let you make this for yourself and just understand that let's see, is there anything special about this? No, it's actually pretty normal. Just understand that the cash account that you see there is a ringer. They're trying to get you to close out the cash account. That's the trick in this problem, so don't fall for it. You don't have to do anything with the cash account. Just ignore that. But then the other accounts, cash account is a permanent account. Service revenue, advertising expense, rent expense, salaries expense, and dividend expense, those are the temporary accounts, and those revenues and expenses get closed out through income summary and then enter retained earnings, and then you make your last entry to close out dividends to the retained earnings account, just as we did just a few seconds ago. Okay, let's go to number 12. Let's look at the working capital and the current ratio. So here is our let's see, balance sheet summary information for the 2 years presented, and calculate for the 2 years presented the working capital and the current ratio. So as of 12/31/2018, we have 76,000 and current assets and 48,000 in current liabilities. And so what is our working capital? Well, it is 76,000 minus 48,000, which equals $28,000. So that is our working capital. What is our current ratio for 12/31/2018? Well, it is 76,000 divided by 48,000. Now, I'm not sure I can do that in my head, but let me see if we can reduce this down a little bit. Are those multiples of the same numbers? let's see, we can divide both by 2, and we would get, let's see, half of 76 is 38, half of 48 is 24. Okay, that's progress. Can we divide them by, what is the largest common denominator of this? It's a shame it's not 72,000 in current assets, because if it was 72,000 in current assets, then the current ratio would be 1.5 times. Okay, in other words, it's 3 to 2 or 1.5 reduced down. So that's not working. So sadly, it's 4,000 more. Well, we know that's all divisible by 4. So let's see, if we divide it by 4, then we're going to have 19 over, if we divide it by 4,000, we'll have 19 over 12. Can that be further divided? 19 is a prime number. No, it can't. So whatever 19 divided by 12 works out to, that's going to be your current ratio, which is going to be a little bit more than 1.5. Go ahead and do it on your calculator yourself, and you'll see what it is. Okay, at 12/31/2019, we have current assets of 295,000. We have current liabilities of 163,500, and so the working capital is just the difference in those two numbers, or 131,500. Okay, so that's your working capital. That's a pretty big number. Somebody had a pretty good year in 2019, and the current ratio is going to be, let's see, what's that? Let's just kind of eyeball it. So it's a little bit less than 1.5. So you can see that the current ratio is decreasing even as the business itself is growing. You know, if it was 300,000 in current assets and 150,000 in current liabilities, oh wait, I'm doing the numbers wrong. Okay, that would be 2 to 1. So it's actually, okay, the current ratio is actually growing. It's almost 2 to 1, but not quite. So maybe 1.8, somewhere in there. Take your calculator and divide 163,500 into 295, and you'll find it for yourself, and it's going to be about 1.8 or something, 1.85 maybe, as the number that you get. So that's that. Now let's look at 14. Okay, number 14, working capital, current ratio. You can see that it's very close. Do the numbers yourself. Which company's liquidity position appears stronger and why? Company J has 17,500 in working capital, and company K has 18,000 in working capital. And if you do the current ratio, company K's current ratio is going to be somewhat higher than company J's, even with lower actual numbers. So company K is going to be stronger both in terms of working capital and in terms of their current ratio. So that's that. Okay, let's go to the problems that we had in your homework, and the problems were problem 3 and problem 5, and in problem set A, and I've done them for you, and you can see how I have done them on my own homework right here. I'm sorry that the homework is not prettier for you to read, but I will read you what I wrote, and then perhaps you can, if you haven't already done so, you can either duplicate it or you can use it to correct what you've written. So it gives you the selected accounts and the normal balances, and it says make the 4 journal entries required to close the books. And so now you have to pick out the revenue and expense accounts to make the first 2 closing entries, And then the third closing entry is, of course, going to be income summary to retained earnings. And then the fourth closing entry is going to be to close the dividends to retained earnings. So your fee earned revenue that you pick out from that list of accounts is $89,200. And so you debit that to get the revenue account closed, and then you put the $89,200 credit over to income summary. And then you take the next are the expenses, and you've got a lot of expenses, and you've got selling expenses of $62,000, and you've got administrative expenses of $29,000, and miscellaneous expenses of $4,140. And when you add them all up together, you've got $95,640. So you close out that account by you make a debit entry to income summary of $95,640, and you make a and I say I made a mistake here on what I did. I forgot the $200. So there we go. Okay. You make a debit entry to income summary of $95,640, and then you make three credit entries: selling expenses for $62,000, administrative expenses for $29,500, and miscellaneous expenses for $4140. And as you can see, those are your second closing entry. So you've closed out revenue, you close out expenses, you close them to income summary, and then when you look at the income summary account, you've had a credit of $89,200 and a debit of $95,640. And so when you take the difference of those two numbers, it is a debit balance, okay, a debit balance in income summary of $6440. So this is going to be a little different for you, okay, because normally you have positive income, but expenses exceed revenue. So what you need to do is you need to make a debit entry into retained earnings of $6440, and then a credit entry to income summary to close out the income summary account for $6440. And then you also see that you have dividends on the list of accounts there for $8,000. And so to close that out, you make the normal entry to debit retained earnings for $8,000, and then credit dividends, and that closes out the dividend account, and that's your fourth closing entry. So that's problem number 3. Now let's look at problem 10. Problem 10 is asking you to prepare a post-closing trial balance. And in the post-closing trial balance, what you're doing, oh no, you're not preparing it, you're finding errors. So gee, let's see what we have here. We're looking through the post-closing trial balance, and let's look at cash. Got $29,900 in cash. Okay, that makes sense. Prepaid insurance, $5,500. Oops, $50,000 credit in fixed assets. You can't have negative fixed assets. So $50,000, you put a credit where you should have a debit. So $50,000 should be over there in fixed assets, and then those are your total debits, and that should equal $85,400. And then notes payable is there for $46,000, and that's the correct normal balance for a liability. But look at common stock, $32,000 in the debit column. That's in the wrong column also. So it looks like you've switched fixed assets and common stock. Fixed assets should be a debit, common stock should be a credit. If you change both of those into the correct columns, then you'll see that both of them are going to equal $85,400. And now your post-closing trial balance balances, which is very good. Now, if you had used some of the techniques that I talk about fixing errors, you wouldn't have found them easily by dividing by 2 or looking for a particular difference. Your difference right there is what is it, 36,000. That's not going to help you much because you've got 2 mistakes, not just one. So if you've got multiple mistakes, you have to go through item by item in order to find them. And in this case, the only errors were to have put the fixed assets on the wrong side in the credit column instead of the debit column, but then have a second mistake of common stock over in the debit column instead of the credit column. And of course, if you do the math, you can see that if you add the 2 errors together, the net error is 18,000, and if you divide 36,000 by 2, you get 18,000, but that's not going to pop out as far as our usual troubleshooting analysis. So if you have more than one error, it's going to take you some extra time to find all the errors. Okay, that's it for the homework for Chapter 5. Good luck on your midterms, and we'll talk with you again soon. Or if you haven't done your homework, please submit your homework. Even if it's late, I have reopened all the assignments to allow you to turn in back homework until next Monday. So please do that as soon as possible. Thanks a lot, and have a great day, and have a good rest of your spring break. Thanks. Bye.